Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, December 15th, 2020. What I'm going to do is a very brief overview on the broad markets. I posted an update this morning with charts, levels to watch, so we won't spend a lot of time there. And then I wanted to talk about a few other things. I want to get to bonds. There's some, I think, some key levels and developments to watch for in bonds that can actually give us some clues to the stock markets. I know a lot of traders don't, a lot of retail traders don't trade bonds. Professional traders do, but the bond market can often be a tell for the stock market. So I'm going to get to that in a second. And quick updates on the other things I've highlighted recently: gold, coffee, copper, and maybe I'll touch on platinum. But all right, let's start out here with the broad market so we can do this quick. Not much to add since this post this morning. This is the uptrend line on the 60-minute chart. We had a minor trend line here, a smaller one with a bearish rising wedge, and that triggered our sell signal recently right there on the breakdown, and we also fell on QQQ. We hit my first target zone, which was a confluence of these two nearby support levels plus the uptrend line. They all came in together, and since then, after hitting the top of that target zone, we've now had a few reactions on this trend line. So that's really what I'm watching. I know in the last updates late last week, and even I believe into Monday, I said, we need to see the bottom of that support zone go. And that will certainly help to see 362.44 go. But as of now, since we've had these additional reactions here on this trend line, that helps to validate it. The more reactions you have on a trend line, the more significant it is. I mean, more eyes are watching it. So I suspect at this point in time, if we get a solid break, especially a solid 60-minute candlestick close below, that should do the trick. All the better if 362.44 goes, and that would open the door to that next target down here. And as I like to say, and unless that happens, support is support. It's not, we're above support right now. We had a minor pullback so far, good for a quick trade for an active trader. And still watching these trend indicators below. I like to use the PPO signal line, the 9 EMA, which is below the zero line. That's often defines the trend, whether you're above or below that zero line on the PPO, especially that signal line. So we did cross below, but then I have this level that sometimes and quite often has acted as the the point of delineation, if you will, that defines bullish trends and bearish trends. So that's a level we're watching now. So if we can get a breakdown there and we get a decent drop, then we'll probably go ahead and break that. And that will then flip the near-term trend indicator, at least this particular one, from bullish, which it currently is, to bearish. So although we had a sell signal here, we're still early on. It's still a bullish trend. We need a little bit more. We need to break this more significant, like get that next sell signal to really increase the odds of a swing tradable pullback. I'm talking, let's say 5 to 8% plus instead of the quick 3% or so drop that we already had. And yes, it is the end of the year, and there's that whole probably buzz out there. I've tried to avoid the headlines for the most part, but Santa Claus rally and all that good stuff that you'll hear about every year. And so look, seasonality does favor the bulls, but again, this time last year, it all depends on what the charts are doing. If you trade off seasonality, you'll get crushed. Some of the biggest moves happen in the market, whether it's bullish or bearish, happen against the trend of seasonality. So you don't want to trade solely on seasonality. You want to trade on the charts. And my point being, this time last year, the markets were in free fall, melting down into the lows on December 24th. That's when the market bottomed. And so therefore, you can't go off that. Now, right now, QQQ, we had a similar breakdown on the minor uptrend line there. QQQ was waiting for SPY, back tested till SPY broke down. Then you had the impulsive drop. Again, good for a quick trade for an active trader. Better than 3%, I believe it was, right there, top to bottom, 3.5% or so drop. Hit that first target, and it's been consolidating there, or it had a couple tags there, and we're above it, but we're still below the breakdown point. So, that sell signal is still valid, but what happened, we hit the minor, minimum target right now, and it's just simple. We need to break this. Obviously, we have two reaction lows a little bit below that, so you want to be safe. You want to see those go, and you want to see that happen with the S&P 500 or SPY breaking down the trend line that I just showed you. If those both happen, I would put very high odds that you know, at least at minimum the next target being hit. And of course these are potential targets. We'll take it one step at a time. Right now, like I said, the price action has been, other than the recent sell signal, you know, the trend is the near-term trend, or intermediate term trend I should say, is bullish. So we need a little bit more evidence, and that would also help if we see this negative 0.49 level on the PPO. We see the PPO cross down below there. That will help to confirm that the trend has changed. So, you know, not any hard signals. And if you didn't short the breakdown there, you could short this kickback rally. Absolutely. I wouldn't let it run too far. I'd keep your stops somewhat, maybe a little bit above that previous reaction high. Allow for one new marginal high. Not much more than that. And otherwise, your next objective entry is going to come on a break below those recent lows on QQQ. Okay, so that's the equity markets in under 6 minutes. Now we'll look at gold real quick. Gold, you know, continues to play well to the technicals. There was our buy zone. That was time to start scaling back into gold posts right there at the very lows. Bounce off the top of the buy zone. And then just recently I said this would be a downtrend line where a reaction was likely for various reasons, including the fact we hit the downtrend line. So that gave, you know, an active trader a chance to, you know, take profits on their gold and or even reverse into a short if they wanted to do so. So where do we go from here? Well, it's going to be choppy. It's been choppy for a while. Gold might chop around. I'm going to give you some things to watch for, and that's why, again, when I want to do the video, there are things to watch for that could determine, you know, whether we're going to come back down, revisit the buy zone, the top, or even get into the bottom of the buy zone. That is certainly possible. I'm going to show you things in the charts. Longer term, I remain bullish. Just intermediate term, it's not an all-in buy signal yet. Certainly, if we take out the top of the, you know, or take out the downtrend line, that will help. If we take out that 181-ish level, that would also be bullish. And once we get anywhere close to those new highs, I think it's safe to say gold will, you know, can take the next major leg up in the bull market. But right now, a little bit of work to be done. Let's look at the futures real quick. So I'm going to show you the good, the bad, and the ugly on gold. And that's why I still think it's a good time to scale in for longer term traders, not a hard all-in entry on gold at this point in time yet. So when we look at the 60-minute chart, these are gold futures. GC is your symbol right up here in the top. And, you know, this was part of the reason for going long recently is the bullish divergence right there, positive divergence on the 60-minute time frame. It's catalyst for this rally. When we hit that downtrend line I just showed you on the daily chart a week or two ago, we had negative divergence on the 60-minute chart, and that's called, you know, led for this pullback in gold. Pulled back to this nice support zone here. It's about 18, you know, 1820-ish, 1820 to 1825. Nice support zone right there. Plenty of reactions, and that's what's been holding gold up. Yesterday we put in, when we hit that there, we also put in a divergent low. So this is, you know, micro trades or active swing trading, you know, 60-minute chart. Look for the divergent lows. Those are bullish. Divergent highs are bearish. Divergent lows bullish. And so it's led to this pop in gold, but right up to this resistance level. These are all the levels I've had on this 60-minute chart here for a while, and you can see how well, you know, gold is trading off those levels. You know, when you put in the divergent high, that 1880-ish level right there capped the advance and pulled back right back to support, which was, you know, well defined, and that rallied up to this level here. We've had a couple reactions around this level, and that capped the rally so far at about 1855.50. Okay, well, where do we go from here? That's the important thing. Well, we did put in this divergent low, and that may be the catalyst for the next leg up. My degree of confidence isn't so high. What I don't like right now is this setup in the US dollar and the euro. I'm going to refresh this chart, make sure it's up to date here. Okay, this is a 60-minute chart of DX. These are the US dollar futures. And you can see a nice, clean, well-defined downtrend line right there. You can see positive divergence right there. Here's small divergence, and that led to a pretty decent rally right there, even within a downtrend. You know, so it's wash, rinse, repeat. These divergent highs right here lead to trend changes or corrections. Another divergent high, and that's led to this whole drop so far. But this is the first divergent low since this one back here. You know, again, that one led to a a pretty nice pop in the dollar right there, small divergent low. This one's even more significant because we also have a downtrend line which will be taken out if these divergences start to play out. So not only do you have the positive divergences, which could continue to build and may do so, they may get burned through, meaning prices just fall down through there and you no longer have divergences, but this needs to be respected if you're in gold. A breakout in the dollar, that would be net bearish for gold. All other things being equal. When I say net bearish, it doesn't mean you're guaranteed to see gold drop if the dollar rallies, but more often than not, it will do that. They have an inverse relationship. And there's a little period of consolidation recently, so also a break above that would be bullish for the dollar, and again, net bearish for gold if that happens. So that's what we need to watch for there. Now, as of now, gold is in a downtrend, and as I like to say, resistance is resistance until and unless taken out. So we haven't taken it out yet, but something to be on the lookout for if you are trading gold or silver or the mining stocks for that matter. They all tend to move together. Okay, and then I always like to look at the euro as well. The euro is the largest component of the U.S. dollar index, and so it's going to have a big impact. It's what, nearly 2/3 of the dollar index, and so wherever the euro goes, the dollar is going to go the other way. So back here you had a divergent high, and you can see that was the end, at least for a while, of this rally right here, and you had a correction. And right now we have some pretty steep divergences building on the euro, and it's not mere coincidence. This is again almost an inverse chart of the US dollar that I just showed you. There's your uptrend line. So these guys are ready to pop. A breakdown here below the trend line would also most likely correlate with a breakout in that US dollar 60-minute chart, and where it goes, hard to say exactly, but again, you need to respect this. The fact that we have a well-defined uptrend line that's getting a little extended, and you have divergences. Again, we're above trend. We could continue to walk above trend. So there's no sell signals yet in the euro here, or a buy signal in the dollar. We could continue to push up and keep those divergences intact for a while. So again, something to monitor. But again, if this breaks down and the euro starts to drop, that's typically bearish. Gold will usually fall when the euro falls. And then one more look at it here. This is the euro-US dollar pair. So you're really looking at, this is the euro moving against the dollar. So when this is going up, the euro is going up. When this chart's falling, the dollar is rising, the euro is falling. And you can see here we have this divergence building here. Last update I said unconfirmed divergent high, but it looks like that bearish crossover, it's close. I wouldn't say it's done even if the lines have crossed. You want to see a clear crossover, and then that will confirm the negative divergence. So this sets the stage for a sizable drop in the euro, and a sizable rally in the US dollar. I could see it priced in the charts here. Sometimes you have to look at this. Bigger picture says, I need to turn that comparison off. Bigger picture says the euro just broke out, the euro-US dollar pair, and I've been highlighting this many months now, and we had a pretty powerful breakout. We rallied up, hit this first resistance there. It's about 122.141 on the euro-US dollar pair, and you can see that divergence also shows through here on this weekly chart. It's unconfirmed. You need to turn this PPO back down, and if that happens, what is a likely scenario, and it would be a pretty good correction in the euro, and again, that's going to put pressure on gold. That would be a back test of this trend line. And again, this is a weekly chart, so that could take a couple months to happen, if it does happen. And if so, then we might be able to continue to scale back into gold at lower levels. The bullish scenario for gold and the euro would be a breakout here and just burn through these divergences and keep on going. And that could easily happen, guys. I don't mean to be wishy-washy here, but we had a breakout above a long-term trend line that's very bullish, and it's been bullish price action since. Have to say I'm leaning slightly towards this scenario. Leaning that way a little bit, but again, I think I've made myself clear. It's not an all-in moment. I wouldn't be all-in short gold, all-in long. We need to see how these levels resolve, and you can react. If we break through there, Well, we need to see additional evidence on the 60-minute charts as well, not just this weekly chart. Weekly charts take a while to get your buy signals and sell signals because you want to wait to see how the candles close at the end of the week. So I'm just pointing this out as kind of bigger picture stuff that, to me, it's really a matter of I'm bullish on the euro and I'm bullish on gold. It's more a matter of is there going to be a little more consolidation or a little more downside in gold before the next leg up? And if so, that might, look something like this on the euro. Or is this breakout the real deal and we're just going to keep going and powering right through these divergences? Certainly a possibility. They both are, and there's not the only two. It's not a binary scenario where gold or euro must do this or this. It can do a lot of things. It can sit here and consolidate for a while at that level. It can pop above it and fall back down. We'll watch the charts as they develop, and I'll continue to post my thoughts on that. I just wanted to say really I'd focus on those 60-minute charts of DX and E7, the Euro futures. If you get those breakdowns and you see they're impulsive, again, that's probably going to lead to a leg down in gold here in the near term. Okay, a quick update on coffee. Coffee continues to look good. Recently broke out above those previous reaction highs. This is a daily chart of Joe, the coffee ETN. So there's a recent breakout. We have some potential divergence building here that I need to point out. So we had a small divergent high right here, especially on the 60-minute chart. It played out for a correction. In fact, that was a small divergent high there. Here, let's jump over to that. We'll go to the 60-minute chart of coffee futures. All right, let me find that. That is symbol KC. I've got it here somewhere. I don't know, my charts down below. There it is, KC. Let's make sure this one's up to date. All right, so KC Coffee Futures, this is a 120-minute chart, not a 60-minute chart. That means every candle is 2 hours instead of 1 hour. Very, trades well to the technicals. You can see the last catalyst, or the catalyst for this rally was this wedge type pattern, bullish falling wedge, positive divergence. We broke out, back tested it, and have been moving higher. This was a small divergent high right here on this 120-minute chart, small correction. A little bit bigger divergent high. Correction was, a little bit higher because we fell from a little higher level down to about the same level, but corrected for a little bit longer, a little bit of correction in price there. All along we held what level is saying needed to hold is that 1.158 level, that's support, and so we finally moved off it. However, and so that is bullish that we took out that previous high. We're making a series of higher highs here. We continue to make higher highs. Here was a high, a little higher here, and higher lows. There's a low, reaction low, and a reaction lows there. So this is an uptrend and respect it for what it is. However, unfortunately right now we have some additional divergence. We ran up and hit my next target there at 1.2713. Stopped right there. That's resistance. There's your next resistance or target after that, and then up there. And in doing so, again, we have some divergence. So if it's the real deal for coffee and we're in this next major leg up, like I suspect we are, that's how I'm treating this trade as a longer term trend or position trade, then we could burn through these divergences, or maybe they play out, but we keep above those previous lows or within this range. If you look at it this way, maybe we chop around a little bit longer, but again, we need to really keep above this 1.1585 level in coffee, and again, nothing would be more bullish than if these divergences just get burned through. In other words, we just keep moving up now, take out the 127.13 level, take out the 130.55 level. That would be quite bullish for coffee, and say that we're probably going to take out those previous highs, and that we are most likely in the next major leg up. And copper, I shared my thoughts on copper with you. This is a 2-hour, 120-minute chart, just like we were looking at on coffee futures. There's your uptrend line. There's your divergence line. So we have this negative divergence with a sell signal pending or to come on a break of the trend line. And then you have some support below it, 340, almost 344 right there. probably get a reaction there. And if and when that level goes, then that's your next sell signal. And those are some potential targets for those of you that trade futures. That's the symbol HG. It might be cut off. There you go. HG are your futures. And your other option is CPER, United States Copper Index Fund. So this is your ETF or ETN type instrument. ETN, I believe, tracks coffee or copper futures. We're below trend on the 60-minute chart. Not the best defined trend line, but either way, those are potential targets listed right here. At least at 21. Well, let's see. Yeah, that is my first target around 21. Pullback target there. And when we look at copper, here's a chart. Let me move this up a little for you. There we go. Here's a long-term chart of copper futures. This is a daily chart, daily candlesticks. Goes back, I think, a decade. That's 10 years of candles. And so what I've noted here is we have a parabolic run right there. See this trend line right here? This is a parabola or a parabolic move right here. And parabolic runs typically don't end that well. They usually end with a very sharp reversal. So on one hand, we do have a breakout above those recent highs right here. Hopefully you can make out this light color I'm using here. We broke out above there, but should that we get a breakdown here from that parabolic run, it wouldn't surprise me that this breakout, or what I expect, it will fail and will probably come all the way back down here to about that $3 level. We're at 353 right now, so that'd be a pretty nice drop if we get all the way back down to about $3 in copper. And you can see negative divergences too right now in addition to that. So we need to break that parabolic trend line or the trend line I just showed you, which is a little easier to use, the straight trend line on that 120-minute chart. The trend line here on the daily chart is parabolic because I used it going off a longer, earlier price points. That's why it's parabolic. This steep move up recently matches with what I showed you on that 120-minute chart. Okay, and we're going to wrap the video up talking about bonds, whether trade ideas, if you're interested in trading bonds, maybe you're an investor and bonds make up part of your portfolio. I've been saying the same thing now for many months. Bonds have about the most abysmal risk-reward profile in history, of the financial markets, because the Fed has taken rates down to the floor. We have a zero interest rate policy here in the U.S. Other countries around the world, some have negative rates. And so there's effectively very little, if any, upside in bonds, but a ton of downside potential. That's because interest rates and the price of bonds move inversely. When rates rise, the price of bonds go down. And so when you're at the bottom on interest rates, we're not going to go negative. Powell has clearly stated time and time again he is strongly against taking the U.S. to negative interest rates. And although it's theoretically possible, look, one thing I know about the Fed is they say one thing and they do another. The markets are going to dictate or force their hand into what they do if they need to do it. So anything's possible, but it's like pushing on a string. They're not going to go to negative 10%. You're going to start going to negative rates. People are going to find other alternatives to put their money in, Bitcoin or whatever it is under the mattress, gold, things like that. And the Fed knows that, so that's why we're probably not going to go much lower in rates. Okay, and what I'll do, and I'm not going to spend a lot of time on bonds, but I'm going to show you we have a lot of the different bonds. We're going to look at treasuries, a couple different maturities. This is the 10-year treasury yield. So these are not the 10-year treasury bond, but the yield index of what the 10-year treasury is paying. And what stands out to me as I've been looking at bonds lately, I haven't been covering bonds in recent months as much as I used to, and I've stated the reasons because the Fed went all out nuclear when COVID hit. Back in the drop in the March lows, they pulled stops they've never pulled before. Emergency charters they invoked to allow them to go in and directly manipulate the corporate bond market, buy junk bonds, buy low-grade corporates, and so they've distorted or masked the true price discovery, the mechanism of price discovery. So we don't really know, and especially in the corporate bond markets, where it really should be priced based on how all those companies are doing, because again the Fed has they're supported that market, and whereas they early on, I read they didn't deploy as much money as they needed to. In other words, they have more dry powder to put in to buy corporate bonds, but it was just their explicit backing or implicit, that is, that say they're going to come in and back those bonds and support that market, and so therefore it blew out the shorts, and brought a lot of money into that market. But again, same thing in the corporate bond market. Virtually no upside potential, tremendous amount of downside potential. But let's look at these levels to watch, because this may affect the stock market. All right, so you have a very clear uptrend line, as I showed you here, and a pretty well-defined resistance level at about 970 right there. You can see reaction high, and that's where we've been bouncing. So this is an ascending triangle pattern right there. There's another longer-term downtrend line that may come into play if we break it, but this is a level to watch for on TNX. Before I get to the other bonds, I want to just show you, this is a weekly chart. I'm going to turn off all these annotations, and we're going to look at how the stock market and bonds are correlated. So what you'll note here is, again, remember TNX is the yield, not bond prices. The 10-year Treasury bond, we'll get to that in a second. That's IEF, and that's going to be an inverse to the chart of the yields right here. So prices and bonds and the yields go opposite. So what is correlated is the stock market. So up top we have this is the red and green bars are TNX. And so here's the yield. This is the stock market in blue right here, the S&P 500. And what we'll focus on, a couple things. I'll just show you that you can see typically they rise and fall together, right? You can see the trends. And there are periods where of disconnect, where one goes up and the other goes down, right? But typically, and here's what we're going to focus on. So there is that correlation right there between yields and the stock market. It's unmistakable, and again, brief periods of disconnect. But you look at the biggest drops the stock market's had. Here, we're coming off the left here. There's a big correction in the market back in 02, 03, a bear market. There's our 2007 to 2009 bear market. There's a big drop right there. So in these periods of sharp corrections, it's unmistakable. That's when you see yields spike or drop sharply, because bond prices are going up, especially Treasury bonds. These are flight to safety instruments, so make no mistake about it. The correlation is very tight there. So that's what we're going to focus on. So if you get that breakout in bonds, that may correlate with a a breakout in or breakdown in the stock market as well. So I just wanted to highlight those strong, very strong correlations when you get the big corrections in the stock market. Here, we can even zoom into recent years right here. There was that big drop in the fourth quarter of 2018. And of course, you saw a big drop in bonds. It doesn't look like much when I'm zooming in. Remember, the bonds aren't going to move as much up or down in percentage terms as the stock market. There was the meltdown in the COVID lows. You can see them both dropping together. And since then, stock market went up, or actually, stock market went up, and bonds have been going up, or bond yields. Okay, so back to the daily charts. These are levels to watch, and again, a breakdown of that with a concurrent breakdown in the equity markets, or maybe it'll be a leading indicator, maybe a tell. If the yields start to drop, that means bonds are rallying. It means institutions, smart money, are moving into bonds. Likewise, we could break out to the upside, and that could correlate with a rally in the stock market. Late year, maybe a January rally. We'll see. But those are levels to watch. And then if that does happen, there's pretty significant resistance there. There's a downtrend line. So these are levels to watch. And again, we'll see what happens. Hard to say from the charts right now which way they're going to break. TYX, there's a nice trend line. TYX is the 30-year Treasury bond yield. And again, you can see we're pinching. Something's going to happen with bonds sooner than later, I believe, because we're pinching between a very well-defined, very significant downtrend line and these near-term uptrend lines. So these are the levels to watch. And I think this is telling us, we're pinching towards the apex of these two, that triangle there. And one way or another, bonds I think are poised to do something soon. May not happen tomorrow, next week, but within the next month or two here, it seems to me. Okay, so you're not going to trade rates directly unless you're trading futures or anything like that, but you can trade TLT if you're an ETF trader, or just watch this. This is TLT, the 30-year, 20-plus year Treasury bond ETF. So these are 20 to 30-year long bonds, Treasury bonds. There's a price channel. It's going to coincide, with breakout here would coincide with a breakdown of that trend line I gave you there. So that's one level to watch. IEF. This is a 7 to 10 year Treasury bond fund. So you see a breakout here above this line would coincide with a breakdown on TNX, the one that I started with there. So again, these bonds are looking like they're a lot of them are poised to make a move. And we can also watch the junk bond market. JNK, again, this market's been distorted. The Fed has stepped in to support corporate bonds. Both of those that are lower tier investment grade, as well as those that are below investment grade. So they have the authority and the means, and they've gone in and done that. But what I'm looking at here, it's the same story. The upside on junk bonds and all bonds is limited, and the downside is quite big. And so you can see the negative divergences forming. I don't have a clean up trend line on JNK. That's one of two big junk bond ETFs. The other one being HYG. And that's what HYG looks like. Couple others to mention. FLN, that's the one fallen. Those are bonds that were recently investment grade and fell down to junk status, or just recently recovered. Either way, this is where the Fed has come in and supported this market as well. These are your lower grade investment grade bonds, and there's a trend line to watch. Break of that trend line could bring us back down here at about $28 or so, and divergence is continuing to build here as well on that one. There's your divergence line, starts there to there. And then finally, LQD, these are investment grade corporate bonds. It's the same story. When you look at, let me turn that to comparison line off. You look at where we're at, we're pretty much, at the floor on rates, and there's virtually nowhere to go but up. When you look at SHY, this is the short-term 1 to 3 year Treasury yield bond fund. SHY right now is yielding, I'm going to have it on another monitor up above, the 30-day SEC yield on this, if you wanted to put your money in this bond fund, because this one's not as volatile as the longer-term bonds. You're going to get paid a whopping 0.2%. That is 0.2%. That is virtually no interest. And so what investors are doing with these treasury bonds, they have nothing but downside risk to the bonds. If all of a sudden rates start to go up and these bonds start to fall, rates stay low, maybe there's a correction in the market and the bonds break out, your upside is very, very limited. Because again, you're at the floor. This is paying near 0%. It's crazy. People are putting money in here solely because they believe it's a safe haven. Let me use one example, and then we'll wrap this video up. Okay, so I got a call from somebody the other day that was interested in Chevron Texaco. Wanted to know my opinion on Chevron Texaco. Said they're not buying. They're buying it for the dividend. It's got about a 5% dividend, they told me, and what I said is, if you would have asked me a couple months ago, right around the time of the election, I did a video highlighting energy sector as the most bullish sector, and this is the top component of XLE. You have Chevron, Texaco, and ExxonMobil are some of the biggest components in there, and so yeah, at the time I would have said, you're buying for the dividend, great, but I go by the charts, and it had a 47% rally since then. There was that big divergent low. It was the same divergent low I pointed out in XLE and all those other energy ETFs, and there's the rally. Point being, we hit my maximum target right there, $42. That was my final target. So my answer was, I think the end of the run, or at least for the very foreseeable future, is over. And their reply was, "Doesn't matter. I'm buying it for a 5% dividend." Well, here's the thing. That conversation, what I think took place about 3 days ago. Okay, Chevron Texaco, and it's not a big drop, or Chevron Corp has dropped 5% in the last few days. That's 1 year. So if you bought this stock and it was at resistance, so my answer was no. I wouldn't buy that stock with your money right now, because this stock is, it's rallied, almost 50% right into resistance, and again, buy a stock for 5% dividend. Remember, 5% dividend is the annual rate. If you hold the stock for 1 year and collect that dividend, assuming it's not cut or eliminated, you get 5% on there. However, if you lose 30, 40%, you're going backwards, and it's called a dividend trap. So, and it's the same thing with bonds. So, not to beat a dead horse here, but especially in these stocks, be very, very careful buying a stock solely for the dividend. If I can make the case to buy the stock for capital, even if I'm looking for yield, I need to see at least a constructive chart, at least a chart that tells me, hey, the stock may not go up much, but it's not going to fall. The chart looks pretty constructive. Maybe it's in a trading range, and I'm buying it, at the bottom of a trading range like CVX. The next buy point would be down here at this 81.44 support. We've hit that level quite a bit. There's also some support down here. That's a stronger case to buy. But after that almost 50% run, I think there's more downside in CVX as well as many of the energy stocks. So that's the point I'm trying to make is, if you're going to buy a stock based on yield, number one, do your due diligence. Make sure that yield is secure and safe. And then finally, of course, make sure the stock has a constructive looking chart. And set your stops, because to go and chase a 3, 4, 5, 6% yield on a stock and then lose 20%, you're going backwards. If you lose 20% on your capital, or your principal, that is. Okay, I think that's it. We'll wrap it up here. You have the levels to watch in the stock market. You have my thoughts on gold, and a couple other things. We'll wrap it up here, and if I see anything else that stands out, I'll get it out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.